Today, shares of Robinhood climb as analysts say the crypto comeback could spark a 70% rally for the stock. A federal judge says the SEC lawsuit against Gemini and Genesis can move forward, and Andrew O'Neill of S&P Global Ratings weighs in on Ethereum's Denkun upgrade and what to expect from the upcoming Bitcoin halving event. I'm Brandon Gomez. Major cryptocurrencies are retreating from their recent highs this morning. By noon Eastern, Bitcoin sank more than 2.5%, back to the $70,000 level. Ether dropping back to $3,800, but Solana was actually a bright spot this morning, climbing more than 6% by midday. And over on Wall Street, I want to mention stock and crypto trading app Robinhood. That stock surging nearly 7.5% by midday after the company reported a 16% jump in assets under custody compared to January. Bernstein also initiated coverage of the stock with an outperform rating, saying Robinhood could rally more than 70% thanks to the crypto comeback. Okay, let's talk about the top stories. A federal judge says the SEC's lawsuit against Gemini and Genesis can now move forward. The regulator claims that both companies sold unregistered securities through the Gemini Earn platform, which let customers lend their cryptocurrency for yield. Well, yesterday, the judge overseeing that lawsuit denied motions to dismiss the case from both companies, saying the SEC, quote, plausibly alleges they broke securities law. Next, the US Treasury Department is reportedly looking into the use of crypto by Hamas ahead of its October 7th attack on Israel. According to the Wall Street Journal, the agency told Congress it's investigating $165 million in crypto-linked transactions that may have helped finance Hamas ahead of the attack. The Journal reports that Deputy Treasury Secretary Wally Adeyemo told Congress in a letter that he's concerned terrorist groups will increasingly turn to virtual assets as they're cut off from traditional financial rails. Last year, after the October 7th attack, the US Treasury focused on Hamas' use of crypto and considered designating crypto mixers as money launderers. Finally, Franklin Templeton says the price of meme tokens is strongly tied to the networks they run on. In a new report, the asset manager pointed to the Solana-based Bonk token as an example, which surged in the last quarter of 2023. Now, at the same time, Solana's daily active user addresses grew by 75% in Q4 compared to Q3. Franklin Templeton says the fact that active addresses grew as Bonk's price surged reflects an even deeper tie between the network and token. Despite the correlation, though, Franklin did point out that oftentimes meme coins have little to no inherent value or utility and are akin to a meme going viral on the internet. All right, for our main story, the halving event is about a month away and Bitcoin has been surging to new all-time highs, partly in anticipation of that key technical event. So how will the halving impact profitability for Bitcoin miners? Well, Crypto World's Talia Kaplan spoke with Andrew O'Neill, Managing Director of S&P Global's Digital Assets Research Lab for Insight. He also explains the significance of Ethereum's Denkun upgrade, which was finalized yesterday.
So this week, Ethereum experienced its next big upgrade, the Denkun update, which is expected to help with scalability. What would you say is the most significant change tied to this upgrade, and why is the update so incredibly important?
Sure. So the big one is EIP 4844, also known as proto-danksharding. And first, it's important to understand where this fits in Ethereum's roadmap. So Ethereum was originally designed to prioritize security and decentralization at the expense of scalability. This means that design decisions were made that made it very straightforward and low hardware requirements to participate as a validator in the network. But the flip side to that was that there were significant limitations in terms of transaction throughput. However, Ethereum has a roadmap to develop scalability, and that roadmap is centralized around or centered on, I should say, on layer 2 rollup chains. These are built off the Ethereum mainnet, and they execute transactions as a batch and return those to the Ethereum mainnet to settle and therefore benefit from Ethereum's security. What is happening with this latest upgrade is that the blocks on the Ethereum mainnet will now have a dedicated space for data posted by layer 2 rollups. This space will be referred to or will create binary large objects or blobs. And so instead of posting data as regular transactions on the Ethereum mainnet, rollups will have this dedicated space. This means that they will not be competing with other activity on the Ethereum mainnet to put through transactions. And that means that they will have their own market for transaction fees. Those fees should then be significantly lower than they are today. So rollup fees are already significantly lower than on the Ethereum mainnet, but that should now change very materially. This is important when we think about applications of Ethereum, particularly in the financial market context. So where scalability is important, but also considerations around permissioning and privacy or can be significant roadblocks as well. We see an emergence of technologies around rollups in the Ethereum ecosystem, and this latest upgrade through Dencun is going to facilitate scalability through those innovations.
I want to turn to another big story we're following, the upcoming Bitcoin halving. The event, which will take place next month, happens every 4 years, and it's where the reward for mining Bitcoin is cut in half. Can you take us through what to expect and what the impact will be on miners? Do you think some operations, especially those with higher energy costs, will be forced to close?
In terms of understanding the impact on Bitcoin miners, it's important to look at their cost structure, particularly around energy usage, as you're referring to. So generally, miners that are using more renewable energy tend to have higher profitability metrics, and those that have more control over their energy supply, that perhaps are integrated directly with energy supply, can have better profitability and may be better positions to withstand the halving. It is important for context to note that the increase in Bitcoin price over recent months is obviously helpful in terms of improving profitability for all miners, but there are significant differences in terms of the cost basis. It's often talked about that they have significant flexibility to switch off units when they become unprofitable, which is helpful, but ultimately units that are switched off are not earning revenue. So it's important to understand then the runway that each miner may have in terms of available cash and in terms indeed of Bitcoin reserves to go through any periods where a significant share of units might be unprofitable. And also then what that means in terms of their ability to invest. The other element of their cost structure is around equipment, and in order to increase revenues, they need to optimize efficiency, modernize equipment. They typically have a replacement cycle of equipment of about 3 years, and what we've certainly seen in recent months is that some of the miners with greater war chests have been able to acquire units from those perhaps with a little bit less flexibility. We may see more of that as the halving occurs, as some entities become less profitable, that those with greater scale and available funds may be able to acquire a significant share of the network hash rate by acquiring equipment from other miners.
I want to touch on something you just said. Do you think many miners won't survive even with Bitcoin's climb to new records in the mix? Do you think we'll see a lot of consolidation among miners post-halving?
I think we will see consolidation. There's clearly differentiation in terms of profitability levels. There is an advantage to scale. And there are also differences in terms of available funds to fund capex, to fund the modernization of equipment, as well as the ability to raise ultimately equity financing to finance those capital spending plans. Debt financing is something that that Bitcoin miners have typically struggled with at scale. Generally, it's a difficult business model to borrow against because revenues are dependent on Bitcoin price. So the mismatch there to fiat USD costs is clearly a significant risk factor and can make it difficult to make debt payments in a kind of downturn in the price of Bitcoin. And that was seen, for example, through the bankruptcy of Core Scientific.
So in a nutshell, why is there so much attention on the upcoming halving event? Why does it matter so much?
So historically, it's been a significant driver in Bitcoin price cycles. The narrative is a little bit different now. Now that we've got ETFs, that's been a very significant differentiator in terms of the supply demand and dynamics of Bitcoin. It also introduces a competition to Bitcoin miners in terms of equity capital raising that to date, investors have seen miners as a proxy for Bitcoin where they were unable to get direct exposure. Clearly, ETFs now compete on that basis. So from a miner's perspective, it puts the emphasis more on them to demonstrate their ability to outperform Bitcoin through earnings. And so then it becomes very important to look at the different profitability levels of miners and what it might mean for their market share post halving.
All right, that's all for Crypto World today. We'll see you back here again tomorrow.